Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
So many times I speak with people who say, so Andrew, I don't have that much time before I'm going to retire and I don't have as much money as I had hoped and I want to make some money. So I have to be aggressive in order to make money. And I say to them, you know what? That's an interesting uh, thing that you put forth there. It's actually a myth because to be aggressive and to make money are not synonymous. People think that, oh, if I'm aggressive, I'm going to make money. Well, if that were true, then it wouldn't be aggressive. It would be safe. And so that's one of the myths that are happening today. So people are being aggressive to make money, but they don't always make money. I'm Andrew Adjemi.
And I'm Daniel Adjemi. You're listening to Financial Strategies. Today, we're trying to draw parallels from recent history and one particular stock with history from 2 decades ago and a decade ago with two huge crashes in the general stock markets. That is really a fascinating thought experiment when we think about people saying, well, it's time to get more aggressive because when you take more risk, you get more return. We hear that a lot, people say. But
That's
the
right.
more you think about it, the more you realize that cannot be true. Because
Right.
if you took on more risk and it always equaled more return, it would not be more risk.
That's right. That's exactly right. And that's one thing. That's why we're having this show today, is to be able to help people to understand that just because they're risking money, or just because you hear that other people are risking money, and maybe some people are making money, that doesn't mean that you're going to. That doesn't mean that risk equals return. I mean, it could equal a negative return, and that's what we saw with GameStop. Because as in the last segment, you were talking about this man called Roaring Kitty, and how he evaluated stock and saw that it was mispriced. It was a good deal when he found it there, and was able to invest into that. But as people, more and more people bought it. It went higher and higher and higher. It became kind of like a game of musical chairs. It was like, how high can it go before the music's going to stop? And then the music stopped, and a lot of people not only found themselves losing money, but found themselves losing more money than what they had invested because of leverage and such, and shorts that they had put on that. Am I correct, Daniel?
Yeah, and there's actually, it's called the greater fool theory. And that's where there's two things going on. One is when things are low priced and when things are perceived to be risky, that's when people don't want to get involved. But then, so GameStop at $4, people didn't want to be involved. But then once it was $400, people were jumping on. Now, which was the more risky, the $4 or the $400 a share?
The 400, the $4. Yeah.
No, the 400 was far more risky than the $4. That's the way that our brains trick us, because after it's been going up, 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 we think it's not risky anymore. But that's when it becomes risky, when we say valuations don't matter. There's no way they could earn enough income, the company, to justify a $400 stock price.
Yeah, and when you're talking about that too, what I would just realize when you asked me that question, that the trick my mind played on me, it's kind of like that stuff that goes along with the dyslexia and so forth, and you think you're saying it the right way, but it's not saying the right way, and it's just interesting how that works, and the psychology of investing, as you're always bringing up. But tell us more about this, Daniel.
Yeah, that is what we have to watch out for. I begged and begged and begged everyone I knew to buy Tesla before the stock split at $200 a share. And people would not do it because it was perceived to be risky. And now I can't get people to get out of it after it's 17, 18x from where we purchased it. That's an example of how our brains trick us.
Right.
And and they wouldn't buy it when it was a good deal, but now everyone wants it. So continuing on in the story with the YouTubers, the Redditors, the Wall Street bets, this whole thing, and Robinhood. So what ended up happening was, as people got more and more involved, it became riskier, which means Robinhood, it's a trading platform. A lot of millennials use it. And the idea is, you're taking from the rich, you're taking from these big firms, and democratizing and letting the small investor invest. And Robinhood, we have to thank, because they are the ones who allowed commission fee trading for like TD Ameritrade, Charles Schwab's, Fidelity. They were the ones who pioneered that, and that's helped a lot of investors. Um, but Robinhood, there's two things people don't know about them. One is that they don't understand the current system. So what they got into some trouble because they allowed people to buy this stock, Gamestop, on margin, and they didn't have the proper protocols to protect against what's called a margin call for the brokerage firm, for Robinhood, not for the investors. And they had to come up with something like $4 billion, and they didn't have the money.
Wow.
So the Robinhooders basically put a couple of hedge funds out of business by doing this short squeeze. And then Robinhood had this margin call that they couldn't come up with the money. And so what they did was they told the investors, you can't buy these stocks. There was a list of stocks that were in this speculative bubble, this crazy mania, this gambling. Um, and they said you can't buy these stocks. And that made the Redditors, that made the Robin Hooders really mad, because they were trying to take one on Wall Street. And they did a very good job of that, but it got out of hand.
Yeah.
And so another parallel is in 1998, before the tech bubble crash, when things were good and everyone was going crazy, there's a hedge fund called Long Term Capital Management that almost took down the market. They were so leveraged up, and they made some bad trades, and the Fed had to come together, bring a bunch of banks together to bail them out. That was in 1998. So that was speculation before we actually hit the big crash. And then again, before the great financial crash in 2009, or 2008, 2007, 2008, there was some speculation going on, and Bear Stearns, probably a lot of our listeners remember that bank. They had two hedge funds go completely bankrupt right before the crash. And these are signs to let you know things are getting out of control. These are things you have to watch out for, alerts that you have to watch out for.
Yeah. And, Daniel, you mentioned that, the greater fool theory, where saying that, there's always somebody that's a greater fool that's going to be able to buy this and pay more for this than what I paid for it, kind of thing. And I just want to point out to our listening audience the aspect of the prudent man rule is kind of almost the opposite, the antithesis of that, which is the prudent man or prudent person rule is one where a person is seeking reasonable income and preservation of capital. Those investments that they might buy in their own personal portfolio when they are investing money for people, whether if they're a guardian or a trustee or that kind of thing. And we're like at the opposite ends from that standpoint. And if you're listening to us today and just joining us, you're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is lessons learned from GameStop and Reddit. Now we have a report that we'd like to give you today called "Universe of Income Generating Alternatives," and you can have that by calling 800-725-7616. And this is going to give you a perspective of some other things that are available out there besides just gambling and hope invested in some of these things that we're talking about today. We also have the book available to you called The Fourth Turning to the Next Five Callers at 800-725-7616. The Fourth Turning for the next five callers at 800-725-7616. We'd love to give you that book, put that in your hand to help you understand what's going on in the world and in the U.S. and the stock market right now, and give that to you free and no obligation for listening to our show. And again, you're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is lessons learned from GameStop and Reddit. And we'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at adjemi.com. That's AGEMY.com.